What's up guys, it's Michael here. In this video, we're going to talk about 5 things that you need to know about capital gains tax. Here we go. So the first thing you need to know that capital gains tax is not meant for only rich people, meaning people such as myself and everyone else, you don't have to be a millionaire, can capitalize on this gain. This is meant for everyone. And the reason why, because most people do not know about it, is because it was never taught in school in the first place. The only way you know about it is when you start working. But even if that is the case, still, majority of the people, I say around 95% or more, still don't really realize this gain. Unless like you're a business owner or you hire a financial officer or maybe you're an accountant yourself. And it's really important is because capital gains tax can range from nearly almost everything. For example, your car, your house, installation fees, businesses and stuff, they have a lot of expenses that can be written off. So it doesn't mean you have to be wealthy to utilize this. You can be basically your average person working a job and you can still utilize this. It's just that you gotta understand how the system works. Number 2, going down the list is, think about it. It is, your home is also not exempt from this and in a way also exempt from this for capital gains tax. Because you think about it, you look at majority of people, what is the most expensive or high value asset that they have? Looking this way more objectively, it is their home. Their home is worth the most in investments. And if you look at it, how you can utilize this for capital gains tax, think about a house. Like for this day and age of pandemic, most houses are going up. But back in 2008, where during the housing crash, during the housing bubble, the prices went down. That can also be utilized for capital gains tax write-off. So basically, if you own a home, if you own more than 2 years, because capital gains tax, it says is 1 year, but there are different categories set up. So for a home, if it's 2 years, you own it more than 2 years, and you sell it, you can utilize this type of tax plan. So if it's make more than a certain amount or threshold, you'd be taxed within that certain category, which is still a great benefit. This is only assuming that you do not own a home that for the previous 5 years and sold. But if you held more longer than that within the first 5 years, you never sold a home for within that time, you sold it, you can utilize that plan. If not, then you cannot utilize it. Going down the list is number 3. It is length of ownership matters. So I said in my previous video, capital gains tax are 2 categories. There are short term and long term. Short term is basically you're working every day. So whatever you work within that day, within a time and hour, you get paid, you get taxed wherever that bracket. That is the most heavy, hard-hitting tax bracket, capital gains short term. So mainly what we're majority of people looking for are capital gains long term. The way the system is set up is to get people to buy a value an asset and hold it for more than a year. And in cases of the previous one I mentioned on number 2, based for a home, that one's set for 2 years because a lot of people are utilizing that law for that extent. Other investments, more than 1 year. Time does matter. So there's a reason why businesses and stocks go up in value because people hold long term because this is what the rule is set up for. Is to utilize our people to invest in stocks, invest in real estate, and what are other necessities that is considered valuable. So people got to remember if you buy something, you got to invest. It's always going to be over a year. So just keep that in mind. Going down the list, number 4, which is you can actually utilize capital gains on losses too. So basically, if your investment doesn't make money and it loses money, you can actually still use this rule and this law to your own advantage. So for example, you buy one stock, right? $50,000, and let's say you want to sell it off, and instead of going up in value, it went down in value about $20,000. So now you have 30 grand left worth of the one value of that stock. You can actually offset that loss, something known as capital gains loss. So basically, when you lose money, something depreciates in value instead of going up, as you anticipated, you can write it off as a loss and you can spread it out because instead of writing it off for that one session, so instead of gaining 50 grand, now you gain 30 grand. So, okay, so now you utilize that single tax bracket. Now within that 20 grand you lost within the 50,000, you can usually write it off in your tax. And when you write it off, it is basically spread out to multiple years. You can take up only a certain amount. So instead of writing off 20 grand in 1 year, you can write it off to multiple years, which is actually insane because that's actually really beneficial if you can think about it. You can offset the loss to other years. That's why it's very important to invest because there's so many benefits that schools and other places do not teach you until you find someone who is an expert in financial situations or financial advisors. You know, the list goes on. But once you learn about it and you utilize it, it will benefit you financially for the long run. The last thing you need to know, number 5, is that a lot of people still understand this because, you know, rules different from country to country, is that businesses are not considered capital gains tax. So hear me out. A lot of people think that running a business is considered as investment or write-offs. Yes and a no. So for example, if you own a business and you're making, let's say, $1 million per year, within that $1 million per year, that is considered capital gains short term because you're making whatever the business comes in. You're not investing to it because you're not holding it for more than 1 year. Whatever comes in, it comes out. But come think about it, what is considered capital gains, long-term investment in your business, and you can use to write it off, is such as maybe office supplies, you're driving your vehicle, building codes, and insulation for your building. All the other stuff is considered capital gains loss or, you know, gains, whatever, one of the two. But the business itself is not considered a capital gains long-term investment because you're using that business to make money. As simple as that. If you're making money within less than a year, or basically within less than a year and making instantly, such as like hire employees. Like for example, a lot of people think that being an employee, you can consider it as like you can use as a business write-off. No, you cannot, because you are not the shareholder or owner of the company. If you have some type of ownership, your name is on the list, then you can utilize that rule. But a lot of people don't realize that. So please keep that in mind. That's it for this video. Please like, share, and subscribe. And I'll see you guys next time on my channel. Peace.